Every week it seems like there's another layoff announcement. Tech companies, retail giants, logistics firms, even the big banks on Wall Street. So if the economy is supposedly so strong, why are all these companies cutting workers left and right? What is actually going on? You see the headlines saying everything is fine, but it just doesn't feel right, does it? Well, today we're going to peel back the layers and talk about what's really happening and what no one seems to be saying out loud. On the surface, the numbers look pretty good. You hear about GDP growth and low unemployment rates, and you think, okay, things must be stable. But that's the big picture, the 30,000-foot view. Down on the ground, where businesses actually operate, a different story is unfolding. Companies are quietly, and sometimes not so quietly, tightening their budgets. They're looking at their spreadsheets, they're seeing the numbers, and they're getting nervous. This is the hidden disconnect between the headlines and reality. While the government might be painting a rosy picture, individual businesses are preparing for a storm. They aren't shouting it from the rooftops, but their actions, like these constant layoffs, are speaking volumes. It's a classic case of watch what they do, not what they say. The big economic indicators are like looking at the ocean from a satellite. It looks calm. But on the surface, the boats are getting tossed around by some serious waves. So, what's causing these waves? A big part of it goes back to what happened after 2020. Remember the Great Resignation? The scramble for talent? To attract and keep employees, companies across the board had to raise wages, sometimes significantly. In 2021 and 2022, it was a workers' market and employers had to pay up. That was great for employees at the time, but now the bill is coming due. Those higher wage costs are now colliding head-on with shrinking profit margins. Sales might not be growing as fast as they were, and costs for everything else are still high. Suddenly, that higher payroll looks less like a smart investment and more like a massive liability. Companies are caught in a squeeze. They boosted salaries to compete, but now the economic environment has shifted, and they can't sustain those costs. It's a painful correction, and unfortunately, it's the workers who are paying the price. Here's another piece of the puzzle, the productivity gap. During that hiring frenzy, companies brought on new people at a rapid pace. The mantra was growth at all costs. They staffed up, expecting a huge, sustained boom in business. But here's the thing. That boom in productivity never really materialized. Just because you hire more people doesn't automatically mean you get more output or more efficient output. Then, a wrench got thrown into the works. Interest rates started to climb. Suddenly, borrowing money became expensive. That cheap cash that was fueling all this hiring dried up. And those new hires who were once seen as assets for future growth suddenly became very costly. When you have high payroll costs and low productivity gains, and the cost of capital skyrockets, something has to give. Companies looked at their balance sheets and realized they were bloated. The math just didn't add up anymore. This has led us directly into what I call the corporate restructuring era. If you could be a fly on the wall in executive boardrooms, you'd hear a lot of confessions. You'd hear CEOs saying privately, "We overhired." Or, "We hired for a level of growth that simply never came." It was a classic case of getting ahead of their skis. They were optimistic, maybe too optimistic, and built a workforce for a future that didn't arrive as planned. Now, they're forced to correct course. They call it restructuring or right-sizing, which are just corporate buzzwords for layoffs. They're admitting, in a roundabout way, that they made a strategic error. They bet on a future of endless growth, and that bet didn't pay off. This isn't about one or two bad companies. It's a trend we're seeing across multiple industries. They're all coming to the same conclusion. They have too many people for the amount of business they're actually doing. And then there's the big one, the one that's quietly accelerating this whole trend, AI and automation. For years, we've talked about AI as this futuristic thing. Well, the future is here. Companies are looking at their workflows and realizing that new AI tools can do a surprising amount of the work. They're asking themselves, why should I pay 5 people to do a task when I can do half of it? And maybe 1 or 2 people can manage the rest? This isn't just about robots on an assembly line anymore. We're talking about AI writing code, creating marketing content, analyzing data, and handling customer service. So the new layoff strategy isn't always about firing existing employees. It's about not replacing the ones who leave. It's about quietly integrating AI and slowly shrinking the human workforce. This is a subtle but powerful force that's putting immense pressure on the job market, and it's only just getting started. All of this brings us back to that illusion of a strong economy. How can all this be happening if the top line numbers look good? It's because those high-level numbers like GDP are masking a dual crisis. At the corporate level, you have the stress we've been talking about: rising costs, productivity gaps, and the need to restructure. At the same time, at the household level, families are feeling immense stress. The cost of living is still incredibly high. Groceries, rent, gas, it all adds up. So you have this bizarre situation where the overall economy, on paper, seems fine, but both the companies that power it and the households that depend on it are feeling squeezed from all sides. This is the core of the disconnect. The official story isn't matching the lived experience of millions of people and thousands of businesses. It's a house of cards that looks stable from a distance, but it's trembling up close. And who gets hit the hardest in this scenario? It's the middle class, middle-income workers. These aren't typically the entry-level, minimum-wage jobs, nor are they the top-level executives. The jobs being cut are often the project managers, the mid-level marketers, the HR specialists, the software engineers who aren't the top 1% of talent. These are the salaried professionals who were hired during the boom and are now considered expensive redundancies. They make a good living, but not so much that they're indispensable. This is the middle-class squeeze in action. Their salaries are a significant line item on a company's budget, and in a cost-cutting environment, they become targets. This ties directly into what we've discussed before about the hollowing out of the middle class. It's not just about wages not keeping up with inflation. It's about the very jobs that form the backbone of the middle class becoming unstable. If this all feels strangely familiar, it should. We can see short historical echoes of this exact pattern. Think back to the period just before the 2001 dot-com recession. The headlines were still pretty positive, but tech companies had quietly started laying people off for months. Or look at late 2019 and early 2020, just before the big crash. There were signs of corporate stress and initial layoffs starting to happen, even as the official narrative was one of a strong, robust economy. Layoffs are often a leading indicator. They are the canary in the coal mine. They begin happening well before the economists officially declare a downturn. Businesses on the front lines feel the slowdown first, and they react by cutting staff. The official data just takes a while to catch up. So, what we're seeing now isn't unprecedented. It's a pattern, and it's one we should pay attention to. So, what does all of this mean for you, for us, going forward? The goal here is not to spread doom and gloom. It's to provide clarity. We are not necessarily in a collapsing economy, but we are absolutely in a restructuring economy. The fundamental nature of work and value is shifting. Companies are being forced to become leaner and more efficient, and they're using technology to do it. The impact of this restructuring is not being felt evenly. It's the middle class that is absorbing most of the shock. Understanding this gives you power. It helps you make sense of the confusing headlines and prepare for what's next. It means focusing on skills that are adaptable, that can't be easily automated, and staying aware of the real trends happening beneath the surface of the news. The world isn't ending, but it is changing, and being aware is the first step to navigating that change successfully. Thanks for watching and for taking the time to understand these complex issues with me. If you found this video helpful, please give it a like and share it with someone who might need to see it. And of course, don't forget to subscribe for more deep dives into what's really going on in our economy. I'll see you in the next one.